Let's jump right into episode 8 of our explainer. Today, we're tagging along with an audit team to figure out why a perfectly plausible story, well, why it isn't always the full story. We're going to dive into a case study where everything just seems to line up beautifully on the surface, but a rigorous approach reveals something else entirely.
So, you might be wondering, what exactly happens when a management explanation sounds completely right, but standard procedures demand we look a little deeper? It's a fascinating procedural question, and it really sets the stage for our investigation into XYZ Limited. You know, in auditing, you frequently hear answers that make absolute logical sense, but separating what sounds true from what can actually be mathematically proven, that is where the real work begins. Okay, so we joined the audit team, and they're performing analytical procedures on the company's results for the year at XYZ Limited. Basically, analytical procedures involve evaluating financial information by looking at the plausible relationships among both financial and non-financial data. Essentially, the team is digging into the numbers to see if the trends hold up to expected patterns, or if there are unexpected fluctuations that need a closer look.
And the contrast they find is pretty immediate. The trainee article on the team is preparing a quarterly comparison of the gross margin. For quarters 1 through 3, margins are totally stable and predictable. But when he looks at the final quarter, he immediately spots a huge anomaly. There's this distinct margin spike right alongside higher sales volumes.
To get specific, the gross margin in the final quarter has unexpectedly jumped by 3 percentage points compared to each of the preceding 3 quarters. Now, in a stable business environment, a sudden 3% spike in the final stretch of the year, that's a material fluctuation. It's an inconsistency that you can't just casually note. It absolutely demands a clear, documented reason.
Following protocol, the trainee article takes this inconsistency straight to Mr. Menon, the Chief Financial Officer of XYZ Limited. And when asked, CFO Mr. Menon provides this immediate, totally reasonable answer based on 2 late-year events. He says the sales mix shifted toward a higher margin product line and that the price of a key raw material fell. To be precise, Mr. Menon explains that a large customer moved its ordering, which caused that shift in the sales mix. On top of that, a new raw material supply contract was signed in December, lowering input costs. Honestly, this explanation makes perfect business sense. It gives specific, logical drivers for both the revenue and cost changes, and it seems to completely answer the trainee's question. So the trainee accepts the alibi. He writes the CFO's explanation right into the working paper, notes that the variance has been discussed with management, considers the whole issue resolved, and moves on. On the surface, this feels like a really efficient piece of work. But this is exactly where the real investigation begins, because recording an explanation, that's not the final step.
The audit manager stops at that working paper during her review, and she steps in. Now, her objection isn't that Mr. Menon's explanation is wrong. Actually, she notes it's probably at least partly right. Her fundamental issue is that the working paper contains an explanation and literally nothing else. A management explanation is a source of audit evidence, sure, but it isn't corroboration in and of itself. It stands completely unverified. And this brilliantly illustrates the governing rule for our procedural investigation here, Standard on Auditing 520 on Analytical Procedures. This standard dictates exactly how an auditor has to respond when a fluctuation is inconsistent with expectations. It literally leaves zero room for accepting answers just because they're delivered confidently or sound plausible. The standard demands 2 distinct steps. First, you have to investigate by inquiring of management regarding the fluctuation. Second, and this is critical, the auditor must obtain audit evidence relevant to those responses. So far, the trainee article has only completed the first half. He asked the question, but he completely skipped verifying the answer.
So the team has to initiate the second half. The crucial point here is that they must now gather field work to see if the CFO's claims mathematically hold up. The manager directs the team to get back out there and test Mr. Menon's assertions about the sales mix shift and the raw material price drop, just to see exactly how much of that 3% margin jump they actually explain. Try to visualize this entire 3% margin anomaly as a whole pie. If Mr. Menon's explanation is complete, his claims regarding the sales mix and the pricing should account for the entire thing. The team sets out to quantify this, objectively testing the claims against external and internal documentation. First up, the team tests the claim against dispatch data by product line. By looking at what was actually shipped out of the warehouse, they can verify if a large customer really did shift their ordering to higher margin products. And
The data confirms the claim. It holds up, accounting for roughly a third of the movement we're investigating. So that part of Mr. Menon's story, entirely factual. Next, they test the second claim about the falling price of raw materials. They check the purchase invoices and review the actual new supply contract that was signed in December. Once again, the claim holds up perfectly. The lower input costs are real, and this accounts for another portion of the anomaly. So, the CFO has been completely truthful on both counts. But there is a highly visible gap that remains. Even after validating both of the CFO's claims, the anomaly just isn't fully explained. There's a residual discrepancy. Mathematically speaking, the two events he described simply do not add up to a full 3% spike. So, where does this unexplained residual lead the audit team? Well, this mathematical gap acts like a beacon. The residual isn't just some rounding error, it directs the team's work toward a very specific, targeted area of the ledger. Because volumes were higher and margins spiked in a way that pricing and mix couldn't fully explain, the residual points firmly toward the very end of the financial year. Following that beacon, the team zeroes right in on the last week of the year to examine the final dispatches. They're specifically hunting for transactions that might have artificially inflated the final quarter's revenue without the corresponding costs, or maybe sales that shouldn't have been recorded in this financial period at all. As they build a timeline of these late-year dispatches, a pretty clear pattern emerges. They discover several large consignments that were recorded in the ledger as sales just days before the December 31st financial year-end. But when they look at the supporting delivery documentation for these specific consignments, the dates fall in January, after the year had already closed. And there's the discovery. The team has successfully uncovered a cutoff error hiding right within that residual data. Sales were recognized in Q4 before the actual delivery took place in the new year. This artificially inflated both the volume and the margin for that final quarter. Finding this specific error prompts the team to appropriately extend their cutoff testing to make sure the year-end numbers actually have integrity. The manager carefully concludes the matter. She notes that there is absolutely no suggestion at this stage that Mr. Menon offered his explanation in bad faith. I mean, the explanation he gave hasn't been shown to be false at all. The mix really did change, and the prices actually did fall. The issue is simply that his perfectly plausible explanation didn't cover the whole movement. Afterwards, the trainee article asks a really fair question. What should he have done differently given that the explanation sounded completely right and actually turned out to be largely true? In response, the manager delivers this incredibly powerful professional philosophy. She says, sounding right is exactly the reason to test it. She explains that an explanation that fits the facts too comfortably has usually been chosen for exactly that reason. Human nature naturally gravitates toward the most logical, frictionless answer. But if an alibi sounds completely frictionless, that is precisely the trigger demanding rigorous audit corroboration. You simply cannot rely on plausibility alone. The real question for an auditor performing analytical procedures under Standard on Auditing 520 is never merely whether an explanation is plausible. The question is whether it accounts for the entirety of what was observed. It's the transition from just accepting a good story to demanding complete, rigorous accounting. The manager's decision to extend cutoff testing was driven entirely by that unexplained mathematical gap, not by some underlying suspicion of the CFO. It leaves us with a final question for any professional. When a convenient story covers most of the facts, will you accept the comfort of plausibility, or will you have the discipline to hunt down the residual?